In this segment, we're going to look at accepting additional business, also known as a customer special order. Remember, relevant data involves future costs that differ among the alternatives. The decision to accept additional business should be based on incremental costs and incremental revenues. Incremental amounts are those that occur if the company decides to accept the new business. Management needs to know whether accepting the offer will increase net income. So if ABC currently sells 100,000 units of its product, the company has revenue and costs as shown below. Sales of $10 per unit, their total expenses of $9 per unit, they have a profit of $1 per unit sold. And this is what it is in total. ABC is approached by an overseas company that offers to purchase 10,000 units at a cost of $8.50 per unit. If ABC accepts this offer, total factory overhead will increase by $5,000, selling expenses will increase by $2,000, and total administrative expenses will increase by $1,000. The question is, should ABC accept the offer? If we were to look at things the way they stand, this one-time order is offering $850 per unit, $85,000 in total, but it's costing the company $9 per unit, which would result in a 50-cent operating loss for each unit that is sold under this special order. However, if we do this initial analysis, it could lead to the incorrect decision. What we need to do is only look at incremental revenues and incremental costs that differ among the alternatives. The sales of this one-time offer will be $85,000, which is the number of units times the selling price of $850, $85,000. The direct material costs are incremental. They have to pay the direct materials in order to create these products. So the cost for direct materials, 10,000 units at a cost of $350 each. Direct material costs associated with just this order, $35,000. In addition to the direct material costs they will incur to fill this order, they will also incur additional direct labor. At 10,000 units, $220 apiece, total additional direct labor costs of $22,000. The additional expenses, overhead, selling, and admin, are for the most part fixed. They will not change, except because of this one-time order, $5,000 in additional overhead, $2,000 in additional selling, and $1,000 additional administrative expenses will be incurred. So because these costs will not be incurred if they don't accept the special order, they are relevant. So the total costs associated with just this order are $65,000. $85,000 would be the revenues earned from the sale, cost of $65,000 resulting in a profit of $20,000. Even though the $850 selling price is less than the normal $10 selling price, ABC should go ahead and accept the offer because it will overall increase their net income by $20,000. While the quantitative analysis indicates an increased profit from accepting the special offer, management also needs to keep in mind qualitative factors, such as customer demands the same price again in the future, or existing customers start demanding a lower price. Competitors start to drop their prices, so we start competitor price wars. We might have lost customers due to special treatment of one order. All of these are negative to the company in the long run. Even though in the short run, that one-time special order will bring in additional profit, they may want to not consider accepting it if the concerns about some of these qualitative factors are significant. So when a company is trying to accept a special order from a customer or not, they need to not only look at quantitative, what are the additional revenues and additional costs associated with just that order, but they also need to look at the qualitative factors as well.